Welcome to Breaking News to Trading Moves. You are looking at a market environment right now where, well, beating expectations is no longer a guaranteed ticket to a stock rally.
Right, yeah. It takes a lot more than just good numbers these days.
Exactly. So here is the exact headline we are looking at today. Adobe has raised its outlook, but the exit of its CFO has heightened concerns over its AI strategy.
And that is the core tension driving the price action right now. The numbers on the financial spreadsheet are pointing firmly in one direction, but the reality inside the executive suite is pointing somewhere else entirely.
Yeah, totally opposite directions. So today we are going to review the exact financial numbers from Adobe, detail those executive changes, and then, identify the specific winners and losers across the market based on this news.
So that's good. Let's get into it.
Think about it like a sports team that just posted a winning record.
Right.
They are heading into the playoffs. The stats look absolutely incredible. The fans are ready. But suddenly, the head coach and the general manager announce they are quitting right before the postseason begins.
That's a rough spot to be in.
It really is. So how do traders typically evaluate a stock when the financial metrics and the leadership stability point in completely opposite directions?
Well, they apply a heavy discount to the valuation, plain and simple. Markets operate as forward-looking mechanisms, and leadership stability is the primary lens through which that future execution is viewed.
Makes sense.
Yeah, so we should probably start by looking at the actual financials because they were undeniably strong. The company raised its fiscal 2026 revenue forecast to between $26.5 billion and $26.6 billion.
Okay, wow.
Yeah, and they also increased their adjusted earnings guidance to between $24.35 and $24.45 per share.
Those are really robust projections. They aren't just beating the current quarter's expectations. They're actively raising the bar for the future.
They absolutely are, and the most crucial metric they reported was regarding their artificial intelligence products. Adobe's AI first annual recurring revenue more than tripled, crossing the $500 million mark.
Wait, $500 million?
Yeah, we really have to pause on that number because annual recurring revenue is, well, it's the absolute holy grail for software companies.
Right, because it proves customers aren't just trying out a novelty AI feature once and walking away. They are actively subscribing to it.
Precisely. It shows real, durable monetization. When a user subscribes, it tells the market that the AI tool is providing ongoing, necessary value to their daily workflow.
Yeah, it's sticky.
Exactly. Earning $500 million in recurring revenue strictly from AI products proves that their heavy investments in artificial intelligence development are actually translating into steady cash flow.
But despite those excellent numbers, the market reaction went the other way. Adobe stock, ticker ADBE, fell about 5% in extended trading.
Yeah, and the catalyst for that drop was entirely focused on the leadership departures. CFO Dan Durn announced his departure to join Marvell Technology.
Okay, so he's out.
Right. And Steve Day will step in as interim CFO starting June 15. A chief financial officer leaving a mega-cap tech company is always a notable event on its own, but you have to look at the broader timeline here.
Oh, right, the CEO.
Exactly. This news follows CEO Shantanu Narayan's announcement just 3 months prior that he plans to step down.
So within a single quarter, the two top architects of the company's financial and strategic future are basically on their way out the door.
Leaving the company searching for permanent leadership right in the middle of an intense, highly competitive race in AI-powered design.
Well, let me stop you there and push back a little on the mechanics of that 5% drop.
Sure, go ahead.
Is that just a standard automatic reaction? Meaning algorithmic trading bots scan the headline, see the words CFO departs, and automatically sell off a portion of the position? Or do the back-to-back exits of the CEO and CFO indicate a specific, tangible vulnerability regarding Adobe's AI strategy?
It points heavily toward a specific strategic vulnerability rather than just, a mechanical algorithm sell-off.
How so?
Think about what a chief financial officer actually does at a technology company of this scale. They aren't just counting the money. They dictate capital allocation. In the current era of artificial intelligence, capital allocation means deciding exactly how many billions of dollars to spend on data centers, compute power, and talent acquisition.
So they basically hold the keys to the engine room.
They do. So when you lose both the CEO and the CFO back to back, right as your competitors are aggressively trying to steal your market share with new generative AI tools, well, it sends a glaring signal to traders.
A signal that things might get messy internally.
Exactly. It signals that the internal transition might be turbulent. The 5% drop reflects a premium being wiped out. I mean, investors previously paid a premium price for Adobe's perceived stability and dominant market position. Without that leadership stability, that premium vanishes.
Got it. Okay, so if Adobe's leadership shakeup is causing panic at the top, what happens to the companies sitting right below them? That brings us to the direct losers from this headline. Adobe, ticker ADBE, is clearly the direct loser because their raised financial outlook just couldn't offset the executive departures. But this sentiment rarely stays contained to a single stock, does it?
Oh, it spreads quickly. This market reaction is likely to weigh heavily on other highly valued subscription-based design software companies.
Like who?
We're looking at companies like Autodesk, ticker ADESK, and PTC, ticker PTC. These businesses share a very similar model to Adobe. They rely heavily on recurring subscriptions from professional designers, architects, and engineers.
So it becomes a game of valuation contagion. If the valedictorian of the class is struggling, the rest of the students get penalized too.
That is the exact logic traders apply, yeah. If the undisputed leader in the design software space gets punished by the market despite posting great revenue numbers, traders will immediately start questioning the high valuations of Autodesk and PTC.
Does that skepticism broaden out even further, though, like to high valuation application software in general?
It does. We have to categorize companies like Salesforce, ticker CRM, ServiceNow, ticker NOW, and Intuit, ticker INTU, as losers here as well.
But they aren't direct competitors to Adobe, right?
No, they are not direct competitors in the graphic design space, but they share a nearly identical market profile. I mean, they are massive, established software platforms currently trading at premium valuations based on their own AI promises.
Ah, I see. So the lesson from Adobe's decline, then, is that simply beating earnings expectations is no longer enough to protect a software stock.
The bar is officially higher. These companies must prove to traders that their massive artificial intelligence investments are creating durable revenue rather than simply driving up their research and development costs.
Right, because for the past year, just mentioning an AI development roadmap was basically enough to boost a tech stock.
Exactly. But now Wall Street wants to see the receipts on the balance sheet.
It sounds like a much harsher grading scale for the entire software sector. Are companies like Salesforce and ServiceNow getting penalized purely by association, meaning investors start worrying about executive succession or internal strategy in the broader tech landscape, and suddenly everyone takes a valuation hit?
The margin for error is essentially zero right now. It isn't necessarily that investors think Salesforce or ServiceNow have imminent CEO departures looming.
Right.
The issue is that when a massive, dominant incumbent like Adobe shows a crack in its armor, even if that crack is just executive turnover, it reminds traders that these towering tech valuations are fragile.
Because if you are paying top dollar for a stock, you expect flawless execution across the board.
Flawless execution is priced in. Any hint of internal distraction or leadership hesitation makes traders want to take their profits off the table immediately and move their capital to safer bets.
Speaking of where traders move their capital, let's look at the beneficiaries. We can start by following the executives. Marvell Technology, ticker MRVL, stands out as the most direct winner in this entire scenario.
Oh, absolutely. They are the immediate winner because they successfully hired Dan Durn as their new CFO. Marvell is pulling a highly experienced executive away from a massive software company to help steer their own financial strategy.
And Marvell is currently expanding its position in custom AI, silicon, and data center infrastructure, right?
Yes, exactly.
So bringing on a CFO of Durn's caliber sends a strong signal to the market about their growth ambitions.
It tells the market they are scaling up rapidly and need top-tier talent to manage that growth. And beyond just the executive hire, there is a broader validation happening for the hardware sector as a whole.
Okay, tell me more about that.
Well, companies like Broadcom, ticker AVGO, and NVIDIA, ticker NVDA, also land firmly in the winners column based on Adobe's numbers.
How so? Does this tie back to that $500 million recurring revenue figure you mentioned earlier?
It ties back directly to that figure. Adobe's rapidly growing AI revenue confirms a crucial dynamic. Software companies are still investing heavily in generative AI products, and more importantly, they are successfully monetizing them.
Right, people are actually paying for it.
Exactly. And to build and run those generative products, software companies need immense computing power. The heavy lifting for that compute power is done by the chips and infrastructure makers.
So it is a continuous loop. Software giants are essentially forced to keep buying hardware from Broadcom and NVIDIA to stay competitive.
Adobe's revenue growth proves the end-user demand actually exists. If end users are paying for the AI, It justifies the continuous, massive hardware spending by the software companies. The chip makers win as long as the software companies keep building.
That makes total sense. Let's pivot to the direct design challengers now. Figma, ticker FIG, is identified as the clearest direct beneficiary of Adobe's leadership uncertainty.
Right, they are the main alternative.
Figma competes directly for professional designers and product teams with its collaborative cloud-based tools. But I want to explore the mechanics of this Figma angle.
Okay, what are you thinking?
Does leadership uncertainty at a massive incumbent like Adobe legitimately create a fast-track opening for a challenger like Figma? Corporate IT departments do not just rip up massive multi-million-dollar software contracts overnight because a CFO left. I mean, the enterprise sales cycle is notoriously slow.
You are totally right that enterprise sales cycles are incredibly slow and bureaucratic. An IT department will never rip out Adobe tomorrow just because Dan Durn went to Marvell.
Exactly.
However, enterprise software contracts are constantly coming up for renewal. Think about the mechanics of a Fortune 500 procurement process. When a chief information officer is evaluating software renewals, they look heavily at vendor risk.
They want stability above everything else.
Right. So when that chief information officer sees back-to-back exits from the CEO and CFO of a key vendor, it raises a massive red flag. It creates hesitation about the vendor's long-term product roadmap.
And that's where Figma comes in.
Exactly. When that hesitation exists in the procurement office, a challenger like Figma gets a foot in the door.
So it is less about immediate cancellation and more about winning the pilot programs.
Yes. Figma's enterprise sales representatives can walk into a pitch meeting and highlight the uncertainty at the incumbent. They can point to their own steady collaborative innovation.
A much easier sell when the client is already doubting their current setup.
It doesn't happen overnight, but leadership uncertainty absolutely accelerates the willingness of risk-averse enterprise teams to pilot Figma's tools alongside Adobe's, which is the first step to eventually replacing them.
It is about seizing the narrative during a moment of corporate hesitation. Very compelling. Now let's explore the secondary winners and losers, specifically comparing broad productivity platforms against standalone marketing tools. We have big tech integration sitting clearly in the winner's circle.
Without a doubt. Microsoft, ticker MSFT, and Alphabet, ticker GOOGL, are massive beneficiaries in this current landscape.
Why them specifically?
They win because they can place AI-assisted image creation, presentation formatting, and content generation tools directly inside the productivity platforms that businesses already use every single day.
The distribution advantage is immense. If a company is already paying for Microsoft Office or Google Workspace, and those platforms suddenly offer generative design tools right inside the apps, well, it drastically reduces the need for that company to go outward and buy specialized design software.
They own the daily workflow, which is the most valuable real estate in enterprise software. But there's another group of secondary winners that is highly compelling: digital advertising platforms.
Meta platforms, ticker META, The Trade Desk, ticker TTD, and Pinterest, ticker PINS. Walk us through how an advertising platform benefits from AI design tools getting better.
It all comes down to the underlying cost of creative production. Historically, producing a high-quality video or a polished image campaign for an ad network was highly expensive and very time-consuming.
Oh yeah, lots of moving parts.
You needed agencies, designers, and multiple review cycles. Because of that high production cost, brands would typically only produce a handful of variations for any given advertisement.
The creative process was a bottleneck.
A massive bottleneck. Generative AI tools remove that bottleneck. They drastically reduce the cost and the time needed to create different versions of ads, images, and marketing videos.
So a brand can generate 50 subtle variations of a single ad for the cost it used to take to produce just one.
And that changes the entire advertising model. Lower creative production costs actively encourage brands to test more campaigns. They can personalize visual content for dozens of highly specific niche audiences.
Wow.
But here's the kicker. When brands have more creative assets to deploy, they need a place to actually deploy them. So they buy more ad inventory.
Oh, I see. The cheaper it is to make the ad, the more money they have left over to pay for the placement.
Therefore, Meta, The Trade Desk, and Pinterest are direct winners. They benefit from a greater volume of advertising spending driven entirely by cheaper, faster asset creation.
That is a very clear cause and effect. Connect the dots right there. But on the flip side of this AI capability, we have standalone website and marketing software landing in the loser category.
Right, the standalone guys.
We are looking at Wix.com, ticker WIX, GoDaddy, ticker GDDDY, and HubSpot, ticker HUEBS. As AI becomes more capable of producing websites, promotional copy, and graphics inside large ecosystems like Microsoft, Alphabet, and Meta, these standalone providers struggle to defend their premium pricing.
The underlying logic here relies on bundling economics.
Go on.
If a small business can generate a fully functional marketing site, write all the promotional copy, and create the ad images using tools that are already bundled into their existing Microsoft or Alphabet subscriptions, it becomes extremely difficult for a standalone company to justify charging a premium monthly fee for those exact same services.
I mean, I have to push back on the fate of those standalone companies, though.
Okay, let's hear it.
HubSpot and Wix are not just sitting still while big tech advances. They are actively developing their own proprietary AI tools to help their users build sites and write copy.
They are, yes.
So why isn't a company like HubSpot or Wix building their own specialized AI tools enough to protect them from the larger platforms?
Because the larger platforms control the broader ecosystem gravity. If you're a marketer, you spend your entire day inside your email client, your calendar, your team chat, and your document editors.
That's true. You rarely leave those apps.
Right. So if Google or Microsoft embeds AI website creation directly into that exact existing workflow, it removes the friction of logging into a separate platform.
It is about convenience winning out over specialization.
Even if Wix's proprietary AI is excellent, it is still a separate destination. When corporate budgets get tight, procurement teams actively look for redundancies.
And cut whatever isn't essential.
Exactly. If they see they can get a good enough marketing tool bundled into their core enterprise suite for free, the standalone premium tool often gets cut, regardless of how good its specific AI features might be. The larger ecosystems have a gravitational pull, and that gravity is incredibly hard for a standalone software company to escape.
That makes a lot of sense. Well, let's wrap this up with what traders should be watching moving forward.
The immediate signal for the market is whether Adobe, ticker ADBE, can recover from this initial sell-off. Traders need to watch the price action over the next several sessions closely.
What would a bounce back mean?
A rebound suggests that the broader market has fully digested the executive departures and is choosing to focus primarily on the higher revenue forecast and that crucial AI recurring revenue metric.
It would signal that the financial fundamentals are ultimately winning out over the executive drama. But what if it does not rebound? What if the stock stays down?
Continued, sustained weakness implies that leadership uncertainty and competitive pressures matter more to the market than the quarterly financial numbers.
A loss of trust.
Yeah, it would indicate that traders completely distrust the company's ability to execute its long-term AI product roadmap without its established leadership duo. That kind of sustained weakness is usually what prompts Wall Street analysts to revise their long-term price targets downward.
You have a company doing exactly what Wall Street demands by proving their AI revenue, yet they are still being penalized for the human element of corporate governance. Which brings up a final thought for you to ponder regarding your own portfolios. Look at the software holdings you have right now. How many companies in your portfolio are currently claiming AI development as a future strength versus how many are actually proving, right now on the balance sheet, that their AI investments generate durable, recurring revenue? Because as we see clearly with Adobe today, even having the actual revenue proof is not always enough to protect a stock from market skepticism if the leadership narrative falters. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.